talk about refinancing and answer some basic refinancing questions that consumers might be really interested to hear the answer to. Very, very popular question. Basically, the most popular mortgage product in the United States is the 30-year fixed. If you're currently sitting in a 30-year loan that's over about 3.5%, you should consider refinancing, especially if you've got mortgage insurance on your loan or you intend to stay in your house for an extended period of time, maybe more than 5 years. Definitely consider refinancing. Other people that should refinance are people that are maybe sitting on a significant amount of equity and also a significant amount of debt. The majority of Americans have a lot of home equity right now, but they also have an exorbitant amount of debt. If that is you, and you could utilize some of that equity by refinancing and lower your output monthly considerably, definitely do that. Your interest rate, credit cards, or student loan payments are sitting at probably much higher interest rates than where the 30-year fixed rate is today. So that would be a very smart move to help you lower your overall housing expenses. That's a good question. So you've already paid money to refinance your loan and you've rolled some costs associated with refinancing into your loan, and now you're considered doing it again. What I would say is you're really gonna wanna make sure there's a lot of benefit there. Probably not. Like, let's say you just got 3.5 last year and now you're curious to see if it would make sense to do it again. My fear for you would be that you wouldn't be able to recoup all of those costs of the two refinances combined. You may as well probably stick in your current mortgage product, but we would be more than happy to help you identify that for sure. There's really not a huge downfall in refinancing except two things. One, we're gonna start your amortization schedule over when we refinance. So let's say you've been in a 30-year fix for 4 years. You purchased your home maybe in 2017 and you're in a 30-year fixed at 3.5%, and you've been paying interest for 4 years at 3.5%, and now we're considering refinancing. Well, let's say we could drop your rate to 3% or 2.75, somewhere in that neighborhood. The only thing to consider is that we're starting the 30-year cycle over again. So I use some software with my team that we analyze you starting your loan over versus you keeping your current loan, and it looks to see how each of the loans perform against each other, because it is something to consider how long you've been in your current loan. The other downside of refinancing is it's expensive. It's not super cheap. Even a very inexpensive refinance is going to increase the balance of your loan, because most Americans do not bring money to close a refinance. They prefer to come to the table with $0 when they're refinancing, therefore increasing the balance on their house. So downfall, starting your amortization schedule over and rolling costs associated with the loan into your new loan. So those are the only two downfalls. Our team analyzes very carefully if those two downfalls are substantiated by the savings that you would have through the refinance. And we do that through a software that's called a total cost analysis. So it does all the amortization schedules and it verifies interest saved compared to what the cost or, the position that you're at in your amortization schedule. A lot of Americans are sitting on a lot of equity right now, and they have the idea that they would like to have a slightly larger home, maybe pop the top, or do an addition on their home because they like their neighborhood, they like their neighbors. If you're sitting at a rate that's over 3.5, let's say at 4.25, and you owe $300,000 on your house and you've got a lot of equity, let's say you wanted to borrow $100,000 to do a renovation to your home. You actually, when you're at that high of an interest rate, you can borrow that $100,000 for next to nothing on a monthly basis, meaning it doesn't increase your payment because the difference in rate negates the money that you're borrowing, that $100,000. So I've had people that it really doesn't impact their payment to do that renovation. Alternatively, the sale and the buy side, what I would say is that there might be a little bit more increase in your payment because you're going from one house with one property tax structure to a new, probably more expensive home with a slightly larger property tax installment. So your monthly payment increase might be a bit more than it would be if you renovated. However, if you're thinking that you would feel inclined to move in the next 5 years, regardless whether you renovated and stayed put or you moved, I would highly recommend just looking at that move now rather than renovating. Only because that increase in price going from your current house value to the next one is going to be the easiest and least expensive in our current interest rate environment than it would if you were to wait until, let's say, 2023, and if interest rates are now at 4.5% or 5%, with the property values and the interest rates both going up, it's going to be a rather big jump to the next price point up. So again, if you're inclined to think that you're going to want to move within the next 5 years, my suggestion would be to strongly consider that move up house now. If you're interested to know like the logistics between selling and buying and how to do that with the most ease, our team would love the opportunity to chat with some creative options we have on that front as well. Thank you for watching my video on refinance questions. Have a great day.